Welcome back to Accrued Interest. For today's episode, we're going to go over 3 takeaways from Meta's Q1 2025 earnings release. First, a brief disclaimer. The information presented on this podcast is not and should not be construed as investment advice. Investors should make their own decisions regarding the prospects of any company discussed on the show. I won't bury the lead. Meta beat analyst expectations and the stock was up about 3 to 4% today in early trading. I'm going to explain some of the strategic facts that we learned going through the earnings release. The strong quarter was a welcome reprieve for Meta shareholders. The stock is down approximately 2% for the year, but it's outperforming the S&P 500, which is down about 4.5% for the year. One of the first takeaways is that despite Meta's enormous size, it is still growing its user base, which they refer to as the Family Daily Active People, DAP as they call it, of about 3.43 billion users. That was up 6% year over year. It was impressive that Meta is still finding people on the planet Earth that are not using its services and finding a way to bring them onto their platforms. Next, I want to highlight that Meta sees AI as a tool to not only gain share, but to grow the entire ad industry. I'm going to be referencing some comments from Mark Zuckerberg that he gave on the Q1 earnings conference call. Mark said, quote, "Our goal is to make it so that any business can basically tell us what objective they're trying to achieve, and then let the AI just do the rest." Mark also mentioned AI has made Meta's services better at targeting and finding the audiences, even better than many businesses are finding these customers themselves. Mark mentioned how the AI keeps improving. He thinks that the increased productivity from AI will make advertising a meaningfully larger share of global GDP than it currently is. End quote. For context, over the past 50 years or so on a global basis, it is estimated that advertising accounts for anywhere between 1% to 2% of global GDP. So for Mark's prediction to come true, even if global advertising doubled, it would still only be about 2 to 4% of global GDP. Meta has shown us that more and more users want to consume video. When we looked at Meta's files in the prior video I did on what we learned when Meta was going up against the FTC in the antitrust case, Meta disclosed video represents over 55% of time spent on the Facebook app. One thing to keep in mind is that most users on Facebook do not post video. So in order for users to spend over 50% of their time looking at video, Meta needs its AI to help users discover what they want to see. 17% of Facebook users and 7% of Instagram users' time is actually spent watching content from their friends. While Meta's overall growth was about 16%, we're in our 4th quarter where the majority of the revenue growth came from pricing versus volume growth, impressions. This is not bad, but it's just something to monitor so we can understand how fast Meta might grow in the future. For Q1, pricing contributed to about 10% of Meta's growth worldwide. That is slightly down from the 14% we saw in Q4 and the 11% we saw in Q3. On the other side of that, impression growth, that was 5% for the quarter. This was also the 4th quarter of decelerating impression growth. In Q4, it was 6%, in Q3, 7%, and Q2 last year was 10%. For the long-term health of Meta's business, we're going to want to see higher impression growth because that means that more users are using Facebook apps, creating more ad inventory, and then over time, using Meta's AI models, they'll be able to drive pricing growth. Thirdly, Meta's Q1 operating margin was at a 3-year high. Keep in mind, Meta is still losing approximately $4 billion a quarter on the Reality Labs division. But if you note, for Q1 this year, the total operating income margin was 41%. This was up from 38% in Q1 in 2024 and 25% in Q1 2023. This just shows how large and strong and how durable the operating margin is at the legacy Facebook apps, that they still are able to spend this much money in money-losing operations and still have an operating margin of 41% that would make many other companies envious. Bringing it all together, I like Meta stock. I expect it to outperform for the rest of the year, but the stock is not particularly cheap. It's what I would call growth at a reasonable price. Meta is trading at about 22 times this year's earnings, about 20 times 2026 earnings, and about 17 times 2027 earnings. I expect Meta stock to go higher, but be patient. Meta's multiple is going to be constrained from getting further multiple expansion to 25, let's say, until the economic fears around the tariff situation are resolved. As always, thank you for listening. Don't forget to like this video and subscribe to this channel, and stay tuned for more company updates during Q1 earnings season.